Okay, in this video, we're going to look at how we calculate real and most nominal GDP, and then have a little bit about how we calculate aggregate demand and how we the factors that impact economic activity. So, as we mentioned in the last video, real GDP is looking at increasing growth after adjusting for inflation, where nominal GDP is not adjusting for inflation. So, basically, GDP is the quantity of all goods and services times the price. And when we're measuring economic activity, we want to take out the effects that inflation has on those prices. Basically, economists want to know if economic activity is increasing or just prices are causing our GDP to go up. So real GDP tells us whether economic activity increase has actually increased, whereas nominal GDP may only increase because of prices increasing. So to calculate any increase in GDP, for nominal GDP, you will use current prices. So basically, and the next example will be clearer, but you do the GDP in year 2 minus the GDP in year 1 divided by the GDP in year 1 and then times that figure by 100. So it's 1.2 million minus a million divided by a million times by 100. And that'll get you a nominal GDP increase of 20%. Growth in real GDP, you use year 1 prices, but I'll explain that more a bit later. But basically your formula is year 2 minus year 1 divided by year 1, always divided by year 1, times 100, and you'd get a figure of 10%. So basically, you'll have, in this case here, you could calculate GDP. It's just if you're doing it for year 3 minus year 2 divided by year 2, which will give you 9.3%. For this figure here, it was year 2 minus year 1 divided by year 1, which gave you 3.22%. So it's always the year you're calculating it in minus the last year divided by the last year times 100. That's how you calculate growth. So here's a bit of an example of how the differences between nominal and real GDP. So for nominal GDP, you just calculate the total value of production in that given year. So in year 1, the output of chairs, tables, and tazos is 10 of each, and you just multiply that by the price of each of them to get your total value. So your total value of chairs is 500, your total value of tables is 250, and your total values of tazos is 250 as well. So your GDP is 500 plus 250 plus 250, which gives you a figure of 1,000. Your nominal GDP in year 2 is 10 times 55 plus 12 times 25 plus 9 times 30. Okay, that gives you your GDP in the second year, which is equal to 1,120. So it's 550 plus this figure here, which I think is 300 plus 270, and that will give you your figure of 1,120. So it's just price times quantity in each year, and you plus them together. To calculate real GDP in year 2, you use the output in year 2, but you use the prices in year 1. So to calculate real GDP in year 2, it's 50 times 10 plus 25 times 12 plus 25 times 9, which gives you a figure of 1,025. What we've just done there is by using the prices in the first year, we get an indication of whether the value of production has increased because of the output increasing as opposed to the prices. So if we use the same prices as the previous year, that allows us to calculate whether output has actually increased. When we use the price in the second year, GDP may have increased because we produce more, but it may have increased because of higher prices. So to calculate the change in GDP, so we work out that real GDP in year 2 is equal to 1,025, which is 50 times 10 plus 25 times 12 plus 25 times 9. That's how we got that figure. Then to work out the change in GDP nominal, you do the figure in year 2, you do this figure, 1,120, minus 1,000 divided by 1,000. So you'll end up with a figure of 1,120 minus 1,000 divided by 1,000, which will give you a figure of 12%. Okay, and I'll say that again, this figure minus this figure divided by this figure will give you 12%. To work out real GDP increases, you do the real GDP figure in the second year, so 1,025 minus GDP in the first year, which is 1,000, divided by 1,000, which gives you 2.5%. Okay, so the key difference is that for nominal GDP using prices in the current year, whereas real GDP using prices in the last year. So that tells us basically that if nominal GDP is increasing by 12% and real GDP is increased by 2.5%, that means production is increased by 2.5%, and the other 9.5% reason why nominal GDP is increased is because of increases in price. So the 12% increase in nominal GDP has mainly been caused by increases in price, but the increase in quantity has had a 2.5% impact. So to summarize, if growth in real GDP is above 0, it means the economy has experienced growth in real terms. After removing the effects of inflation, we've produced more goods and services. If real GDP grows faster than population growth, that's when income per person or real income per person or real GDP per capita increases. If we want our real GDP to grow faster than population, that's when we experience higher living standards. If our real GDP grows slower than population, we actually experience lower living standards. So it's all well and good to experience growth, but if growth isn't faster than population growth, then income per person will go down. This stuff here is a little bit trickier. We'll talk about this more in class, but actually I'll just leave that for now and we'll talk about it in class. The key things I want you to get out of this is that real GDP takes out the effects of inflation and uses prices from last year, whereas nominal GDP uses current prices, which generally means nominal GDP grows faster because it increases not only because of increased production, because of increased prices. We want to remove that by taking out the effects of inflation. Measuring aggregate demand. As I said to you in the last video, aggregate demand, one way we measure total production in the country is through the total demand for Australian goods and services. And there's an equation for that. Basically what it is, it calculates all consumption spending, so spending by consumers on goods and services. So whenever you buy cars, clothes, DVDs, iPhones, etc., anytime we spend as consumers, that's included in consumption. Even if we're buying imports, that's included as part of consumption. Investment spending by businesses on plant and equipment, ovens, equipment, hairdryers, taxis, etc. So any spending by by businesses. It also includes spending on new houses, which is included in investment, which is worth noting. Government spending on education, defence, infrastructure, etc. Exports, so any money spent by people overseas on Australia's coal, iron ore, tourism, education, etc. And then imports get deducted because they're not spending on Australian goods and services. So when we import products, they get included in consumption, but they also get deducted because they're not really contributing to our aggregate demand. That's the aggregate demand equation: consumption plus investment plus government spending plus exports minus imports. Imports are included as part of consumption, however, they're also deducted. So if you buy a $1,000 television from Japan, 1,000 is included in consumption, however 1,000 is deducted as part of imports, so the overall impact on aggregate demand is zero. It's not helping the economy. If, for example, say JB Hi-Fi brought it for $800, then sold it to you for 1,000, 1,000 would get included in consumption, then 800 would get deducted, so it would contribute 200 to our aggregate demand. So it's important to recognise if the company in Australia makes a bit of money, then it does have some impact on aggregate demand. Okay, so examples of factors impacting GDP. If you purchase an ice cream worth $5 from the local ice creamery, that's consumption. If you purchase a new house, that would be an example of investment spending. You purchase an import, that's included in the M or the imports. It's also included in consumption, but gets deducted. Selling $1 million worth of coal would be in exports. Purchase an old house. Old houses aren't included because they're not new production, so it doesn't count. Second-hand cars don't count. They have to be new production. And if you purchase a TV from 1,000 and that cost from Korea for 800, then that would contribute 200 to our GDP. Okay. So imports are a deduction because the other components already include imported parts. So not only does consumption include imports, but if we were to buy stuff from overseas, like say for businesses, so say like Qantas was to buy some planes from overseas, that gets included in investment, but has to be taken out because it's not spending on Australian-made goods and services. Yeah, so if you could buy a $1,000 computer from JB Hi-Fi, 1,000 in consumption, 800 gets deducted because it's an import, and it contributes 200 to our aggregate demand. Thank you.